If you've been watching AI stocks go absolutely crazy this week, and trust me, they have been, you're probably sitting there thinking, did I miss it? Is it too late to get in? Here's the thing. I think most people are watching the wrong side of this trade. The real story isn't just the chips. It's not just the software. It's what all of that AI actually runs on, and that's power. Today, I'm going to break down exactly why energy infrastructure is the sleeper trade of this entire AI cycle. We've got 3 stocks I'm really bullish on right now, and just as important, 2 stocks you need to stay away from. Those avoids are just as critical. Let's get into it. All right, big picture first. Tech earnings just dropped. Meta, Microsoft, Amazon, Alphabet, all of them absolutely crushed it. And the number that really got my attention? Meta alone is talking about spending somewhere between $125 and $145 billion on data centers. Just Meta by itself. By 2 years ago, if you added up every single major hyperscaler's AI data center spending combined, you were looking at roughly $250 billion total. Meta alone is now talking about that number. That tells you this trend is not slowing down. It is speeding up. But here's the thing I keep coming back to. To really understand what's going on, you need to get one thing straight. The AI boom is, at its core, a power boom. You cannot train these massive models. You cannot run AI at scale. You literally can't do any of it without enormous amounts of reliable, uninterrupted electricity. That is the real bottleneck here. And right now, the grid is nowhere close to keeping up. Back in 2022, FERC, the federal regulator for the U.S. power grid, was projecting we'd need about 24 gigawatts of additional capacity by 2030. That's like 2.4% growth over 7 years. Basically nothing. By 2024, that number jumped to 64 gigawatts. And last year, 166 gigawatts. That's 16% growth in 5 years. The grid planners got completely caught off guard. And what happens when you can't get power? You get NIMBY. Not in my backyard. Maine almost passed a full moratorium on data centers. Loudoun County in Virginia, literally the data center capital of the world, has made it nearly impossible to get new builds approved. Brookfield walked away from an 800-acre campus in Virginia because they couldn't lock in power commitments. There are data center shells sitting completely empty in Silicon Valley right now, fully built, ready to go, and they just can't get electricity hooked up. So what's the workaround? Because Meta and Microsoft are absolutely not going to stop building. The answer is what I call behind-the-meter power, or dark energy. The idea is simple. Bring your own power. Don't rely on the grid at all. Build your own generation right next to the data center. Oracle, SoftBank, OpenAI, their whole Stargate initiative, they're literally doing this. Stargate Jupiter, their flagship campus, is 2.4 gigawatts, and they're building the whole thing completely off the grid. That right there tells you everything about where this is going. And all 3 of the stocks I want to talk about today are built around exactly this theme. Let's get into the names. First stock, GE Vernova, ticker GV. This company spun out of General Electric, and it's got 3 main business lines. Wind turbines, not what I'm focused on today. Natural gas turbine manufacturing, this is the big one. And their electrification segment, which covers transformers, wiring, all the equipment you need to actually manage and move power around at scale. Now I know exactly what you're thinking. This stock has already had a monster run. How do you justify buying it here? This is where the accounting picture gets really interesting. When GE Vernova spun out of GE, the parent company loaded them up with a ton of legacy costs and overhead. Because of that, their real earnings margin, cleaned up for all that accounting noise, was sitting at around just 3%. Meanwhile, their 2 main global competitors, Siemens and Mitsubishi, are running margins of around 20%. So GE Vernova isn't just in the middle of a massive capacity expansion. They're also in the very early stages of a profitability catch-up. 2 years ago, they were producing 12 to 15 gigawatts of turbine capacity a year. This year, they'll hit around 20. Their goal by 2030 is north of 25 to 30 gigawatts. And every single turbine they sell comes with a long tail of high-margin service revenue behind it. So you've got output more than doubling and margins moving from 3% toward 20%, both happening at the same time. And their order backlog is already sold out to 2030 without any additional capacity expansion. The demand is locked in. Here's a historical framework I really like. If you look back across bull markets in the 90s, the 2000s, the 2010s, when you bought a stock that had already doubled, you had better than a coin flip chance it doubled again. Now add in confirmation from the accounting that the fundamentals are real and the valuation still has room. That hit rate goes up to 60%, 6 out of 10. GE Vernova fits that profile perfectly. The market has picked up on the momentum, but the earnings trajectory still has a long way to go beyond what the current price is implying. I think this company can easily double again from here. First buy, GE Vernova, ticker GEV. Second stock, and this one's going to raise some eyebrows, because this stock is already up roughly 1,500% over the past year, and I'm still bullish on it. Bloom Energy, ticker BE. Bloom makes fuel cells. Without getting too deep into the chemistry, a Bloom fuel cell takes air, natural gas, and a small amount of electricity, and turns it into a much larger amount of electricity. It's compact, it's efficient, and critically, it doesn't need any connection to the grid at all. That is exactly what every major hyperscaler in the world is desperately looking for right now. And the validation at the highest level just happened in a massive way. Remember Stargate Jupiter, the 2.4 gigawatt off-grid campus I just mentioned? They just signed a deal to get all of their power from Bloom Energy fuel cells. The largest AI data center project in U.S. history chose Bloom as their power partner. It doesn't get more validating than that. Now let's talk growth numbers, because this is where it gets really exciting. A year ago, Bloom was producing about 100 megawatts of fuel cell capacity annually. They currently have the manufacturing footprint to scale up to 2 gigawatts per year. And on their last earnings call, management said they're targeting 5 gigawatts annually by 2030. That's a 50x increase in output in 5 years. From an accounting standpoint, if you look at Bloom's reported financials on the surface, they look messy. Restructuring charges, accounting noise, stuff that makes it look like the company is barely breaking even. But when you clean up the numbers properly, Bloom was already genuinely profitable back in 2021 and 2022, years when most people thought they were losing money. The real picture was way better than almost anyone realized. And here's the layer the market is really sleeping on: recurring revenue. Every fuel cell Bloom sells needs an annual catalyst refresh. The reagents inside the cell need to be topped up, and customers can only get that from Bloom. So every megawatt they sell creates this annuity-like revenue stream that just compounds over time. The market hasn't fully priced that in yet. Yeah, the stock is up 1,500%, but the fundamental story has gotten stronger, not weaker. Still bullish. Second buy, Bloom Energy, ticker BE. Third stock, and this one is genuinely off the radar. I think most people paying attention to energy have probably heard about GE Vernova and Bloom at this point. Way fewer people are talking about this one. Kodiak Gas Services, ticker KGS. First question everyone asks when they hear the name: what does a gas compression company have to do with AI? Here's the connection. When natural gas comes out of the ground, it has to be compressed before it can travel through pipelines. Kodiak owns and operates massive fleets of these compressors across major U.S. production basins. They are literally the circulatory system for natural gas flowing to power plants, LNG export terminals, and increasingly to data center power generators. That alone gives them a direct tailwind from the surge in natural gas demand driven by the AI data center build-out. But the more interesting story is the second act. To power those compressor fleets, Kodiak operates huge mobile generator units. And they figured out, wait, we can take these same mobile power assets and sell electricity directly to data centers at even better pricing than we're getting from compression work. They've gotten into Caterpillar's order backlog to buy more generators. They're positioning to deliver hundreds of megawatts of on-demand, behind-the-meter power to data center campuses in West Texas, Central Texas, Pennsylvania, wherever they operate. They can literally drive power to wherever the demand is. And right now, demand is everywhere. It's a double-dip story. More natural gas throughput means more compression contracts, their core business growing organically. And those same assets can be redeployed to sell power at premium prices to data centers. The market isn't pricing in either opportunity at full value. There's also a bigger geopolitical tailwind worth mentioning. The U.S. has an extraordinary structural advantage in natural gas. EQT, the largest natural gas producer in the country, gets gas out of the ground at around $1 per BTU when the market price is around $5. We have cheap, abundant supply. When Europe saw natural gas prices basically double overnight during geopolitical shocks, the U.S. market barely flinched. That insulation is a real asset, and as demand for natural gas keeps growing, Kodiak is right in the middle of it. I'm not banging the table on this one quite like I am on Bloom or GE Vernova, but it is absolutely a name worth owning and watching closely. Third by Kodiak Gas Services, ticker KGS. Now let's talk about the two names you need to avoid. These are just as important. First, avoid NextEra Energy, ticker NE. And I want to be fair here. This is not a bad company. This is literally the largest utility company in the world. They've done an incredible job building out renewable energy infrastructure. On paper, they should be perfectly positioned for the AI data center boom. All the big hyperscalers publicly talk about wanting carbon light power. NextEra is the biggest name in solar and wind. Sounds like a perfect fit, right? Here's the problem. There's a fundamental mismatch between what NextEra sells and what data centers actually need. Data centers need what the industry calls base load power. Power that's on 24 hours a day, 7 days a week, 365 days a year. A data center's power demand doesn't drop at night the way your house does. It's constant, non-stop, no exceptions. Solar doesn't work at night. Wind doesn't blow on command. Battery backup sounds like the solution, but in reality, it's more like battery extension. A big battery installation might stretch your solar output by a couple hours. What about the other 10 to 12 hours when there's no sun and no wind? You just don't have the power. So sure, data centers might include some renewables in their overall energy mix. But they are not going to rely on NextEra as their primary power source. The big contracts are going to natural gas and nuclear players, not solar and wind. The bigger lesson here, the idea that data centers are going to save solar stocks, just doesn't hold up mathematically. Renewables will get a small piece of this. They will not be the primary winners, and that has real consequences for NextEra's growth story at current valuations. Avoid NextEra Energy, ticker NE. Second, avoid AECOM, ticker ACM. Now this one might seem counterintuitive. AECOM is a major construction and engineering firm. We just spent like 15 minutes talking about a historic boom in data center and power plant construction. How is AECOM not a buy? This is exactly the kind of thinking that gets investors burned. A rising tide doesn't lift all boats. It lifts the right boats. AECOM's construction exposure is in the wrong places. Their book of business is heavily weighted toward transportation, water treatment, and wastewater infrastructure. Not power, not telecom, not data centers. They are not the firm winning the contracts that actually matter in this cycle. And the market is telling you this loud and clear. The stock has been getting beaten down since November, while names like Primoris and Mastech, which are actually exposed to the right sectors, have been ripping. When you see a company lag like that while the bigger theme is exploding, the market is sending you a clear message. This company isn't capturing the opportunity the way you think it is. Could you try to bottom fish here and hope AECOM benefits indirectly down the road? Sure, but there are way better ways to play construction and engineering in this cycle. Don't reach for the wrong name just because the sector is hot. Avoid AECOM, ticker ACM. All right, let's bring it all home. The AI boom and the energy boom are the same story. You can't run one without the other. And right now, the energy side is where the most compelling opportunities still live, because the energy story is maybe 18 months into its run, while the chip story has been going for 3 years. The solution the biggest companies in the world are racing toward is behind-the-meter, off-grid power. Bring your own. Don't wait on the grid. And the 3 names best positioned to deliver that right now are: buy number 1, GE Vernova, ticker GEV. Capacity more than doubling by 2030. Margins in the early innings of a huge expansion from 3% toward 20%. Backlog locked in. Still a lot of room to run. Buy number 2, Bloom Energy, ticker BE. Fuel cell technology just validated by the biggest AI data center project in U.S. history. 50x capacity growth on the roadmap by 2030. Recurring revenue model the market isn't fully pricing. Still compelling even after this run. Buy number 3, Kodiak Gas Services, ticker KGS. A double-dip play on rising natural gas demand and behind-the-meter mobile power. Flying under the radar, undervalued on both fronts. Avoid number 1, NextEra Energy, ticker NE. Wrong type of power for what data centers actually need. Fundamentally misaligned with base load requirements. Avoid number 2, AECOM, ticker ACM. Wrong sector exposure inside construction. The market has been telling you this for months. Listen to it. This is not a trade. This is a structural shift in how we generate and deliver electricity in this country. The companies that own the best solutions for reliable, scalable, off-grid power are going to be compounding winners for a long time. If you want to go deeper, I've got a link in the description to a full research report on this whole dark energy theme. More names, more data, the full accounting breakdown. Definitely worth checking out. And if you're new here, welcome. Make sure you subscribe and check out the other videos in this AI and energy series this week. I'll see you in the next one.